Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. Pleased to have as my guest again, Brad Sorensen. Brad is a chartered financial analyst, a CFA, which is consistent with the investment gurus. He's part of Cornerstone Portfolio Research, which is a CFA consulting team that we use and we speak with on a weekly basis. Brad, thank you very much for joining us again.
Thank you. Glad to be here.
So, interestingly, we pretty much scheduled that we were going to do these podcasts or videos quarterly, and we were scheduled for today. And lo and behold, for anybody who has not been under a rock, we've had a few developments this week that have changed things quite a bit, huh?
Yeah, we have. And in fact, I know when it gets serious when my daughter comes home from school and asks me about it and says, "Why is everything so red? And why are everybody talking about this?" So, yeah, the tariff announcement from President Trump on Wednesday caused some ripples through the market, to say the least.
Yep. So I think we should probably announce, given how we all know that, particularly in the last couple months, and very much so in the last couple weeks, and extremely so in the last couple days, anytime anything comes out of President Trump as it pertains to anything, it commands the headlines and impacts the markets on a dime. And so, for the sake of all our viewers and listeners, this discussion is Friday morning, April 3rd, April 4th. So God only knows how things change on a daily and hourly basis. This is going to air on Wednesday next week, which is what, the 8th? 5 days to 9th. So this could all be old news. But the purpose of what we're talking about today really was intended to be talking about more of the economic data. It just so happens that the markets and the headlines are responding to the tariffs. So what I'd like to do today is spend a little bit of time on the tariffs and more time on the economic backdrop. You ready to go, Brad?
I'm ready to go.
Which today also happened to be the release of the jobs report, which we'll talk a little bit more about when we're talking about more of the fundamentals of the economy. So let's talk about the 800-pound gorilla in the room. The 800-pound gorilla is the tariffs. The tariff announcement on Wednesday afternoon, April 2nd, after the market closed, caused the markets to drop 4 to 6% on Thursday. And then subsequent to that, there was China's announcement overnight that they were going to retaliate with tariffs, causing the markets to go down again today. Talk to us about it, Brad.
Yeah, so that's the market had been kind of anticipating these tariffs, and the announcement was, judging by the market reaction, a little bit, they were harsher than investors had expected. They were wide ranging. The minimum was 10%. We're not going to go through all of the individual tariffs, obviously, but they were sold to the public as reciprocal. We'll give you half the tariffs as you charge us. Now, the math behind that is in question, so that's another thing. But people are worried that this will escalate into a trade war, and that's why futures are down again today, because China did retaliate. And I just want to point out that that was the one everybody knew that was going to happen, because China just couldn't lose face. They already charged us tariffs, so they boosted them basically. And that was no big surprise. I'm not surprised the market went down, because that's just the bias that it has right now. But you knew China was going to respond. The interesting thing will be, this is where right now we know what the game is, but going forward over the weekend, next week, next couple weeks, what do other countries do? Do they escalate the trade tensions? Do they raise tariffs on the United States in response to us? That's where it could get a little more problematic, and this downturn could last a little bit longer. in the end, the United States is the 800-pound gorilla. And whether people like it or not, the United States can basically name the terms that they want because these other country economies depend on the United States. So will they lower their tariffs and then the United States will lower theirs, or will they choose to fight the tariffs by raising tariffs, and then we'll see what the United States does in response to that? That's what investors are worried about, that we get into this trade war that is an ever escalating tariff fight.
Yeah. Well, and then there's a tendency for investors to respond or overreact. And I'm not saying that they're overreacting, but this could be an overreaction.
Well, yeah, that's the thing I've been pointing out, that 3 months ago, nothing could go wrong with the United States. We had a president who was business friendly. We had AI that was going to save the world, and never they were going to keep spending on infrastructure and going to take over work and make us much more efficient. Nothing would go wrong if you listen to the pundits. And that's where we were like, well, when nothing could go wrong, that's when things tend to go wrong, because that always happens in these cycles. And now, 3 months later, nothing can go right. The worst possible scenario is being priced in for the tariffs. There's no paying attention to where the economy is right now, what the positive business things that the Trump administration has planned. So we've gone a complete 180 right now. And yeah, between you and me, and I hope nobody's listening to this, I'm glad the futures are down this morning, because that means we're flushing out the froth and we're getting really low sentiment, and that sets up for a potential rebound. If we'd seen a rebound today, then we probably would have dragged on longer. But really, we're pricing in these really bad scenarios. So now we've gone from all the risks were on the downside to now we're getting a lot of risks on the upside, because it only, as you mentioned, a tweet from Trump, a word from Trump, a conciliatory word from the European Union, for example, or Canada, or some deal with them, that can cause the market to go, oh, well, this isn't as bad as we thought, and start to rise again. So we've gone from risks on the downside, which we've seen, to now there's risk to the upside, because a lot of that bad news is now being priced in.
Well, when you say risk to the upside, for the viewers and the listeners, risk to the upside means it could snap and jump up real quickly. I mean, you're at risk of the market taking off and leaving you behind. So,
Investors, we don't want investors to bail out now, because that's the risk, that you're sitting in cash and miss the first 10% up move after the down move, because that's when you try to sell and time the market, you have to be right twice. And that's pretty tough to do, especially in this environment when I don't even know if the president knows what he's going to do in the next 10 hours. So trying to guess what that is as an investor is pretty much a loser's game.
well, we've also realized and recognized that it is very difficult to predict what President Trump is going to do, because obviously everybody was predicting that the tariffs weren't going to be as bad, and lo and behold, they were worse than everybody expected.
Exactly. And now everybody's, of course, saying if you go back and listen over the past 20 years, he's been a big fan of tariffs, and we shouldn't be surprised. But obviously, the investors were surprised.
Well, you know, it's interesting. Last night I saw an interview with Oprah from 1988, where Trump was talking about the fact that there was unfair trade between the United States and the rest of the world, and that's what, 35, 37 years ago. So it's not as if this is something new.
No, it's not. And people probably should have recognized that. And that's the other thing, like most people agree, even you've heard Democrats even say that, yeah, the United States is being treated unfairly in the grand scheme of tariffs. So we don't charge a lot of tariffs historically, and other countries, depending on the country, tariff us to death. There's a great story in the Journal. Harley Davidson motorcycle, some brand, I'm not a motorcycle rider, but costs $28,000 in the United States. Between tariffs and VATs, you go over to Europe, it costs $112,000. Well, that's just really not fair to compete with the European motorcycle makers, to our motorcycle makers. So a lot of people agree that we need to get this more fair. The methods is what's being argued about, but it is what it is. And I think the hope is that at the end of this, we have a more free, fairer trading system for the world. And whether that will happen will depend on leaders of every country making wise decisions.
One thing that I think we talked about in our weekly meeting that you don't really hear much about as it pertains to unfair trade, you hear the fact that there's tariffs, but there's, in addition to tariffs, there's other trade restrictions. And take, for instance, and I'm paraphrasing more so, but there are countries out there that do not allow us to sell into their country certain products, whether it's agricultural products or cars and things like that. So it's not just the example that you used was the Harley Davidson, but if Europe disallows Harley Davidsons to be sold, it's not a tariff, it's a restriction and doesn't even show up on the tariff sort of numbers.
Yeah, and that's where they get their math for the tariffs. They came up with this formula that includes both the blatant tariffs and the restrictions that you mentioned, because there are a lot of those. For example, just the famous one is Europe directly supports Airbus. They're almost a government owned entity. Well, they're competing with Boeing, who's a private company in the United States. And the United States has long said that's not fair. You're giving Airbus an advantage to all because they have government support and funding and ability to access their credit. And so that's just one of the many examples that are out there. And again, I'm not arguing whether this is the right way or wrong way to do it. I'm just saying that's the theory behind this. And most people agree that it did need to be fairer, but obviously investors are worried that at least in the short term, this will lead to a recession in the United States.
Well, that's a great point because there are, and maybe you can talk about that because the biggest fears, of which we always discussed, that the underlying value of the stock market is based on the aggregate of all the stocks, and all of the stock values are based upon their earnings growth, dividends, and dividend growth, but the daily fluctuation is based on emotions. And emotions seem to be riding high right now, and the emotions are fears of inflation and recession. What I'd like to do is take a short break from here because now we're talking about the tariffs. What I'd like to do is pick up and really begin to talk about the economy and how are the tariffs potentially impacting inflation, recession, and then talk about the fundamentals of the economy because that's what you started with. You started with, wasn't that long ago where everything was great. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and I'm still here with Brad Sorensen, Chartered Financial Analyst. And where we left off, we talked more about the tariffs in the first segment, and really, that's all over the news. And the fact of the matter is by the time this airs on Wednesday, it's probably old news, and so many things will have changed. We talked about and left off in the first segment is the fears right now that are driving the market are associated with concerns of inflation, but more so of us going into a nasty and worse yet prolonged recession. Brad, you care to talk about that, please?
Sure. So the thing to remember is that the economy isn't just one There's never just one factor impacting the economy. So tariffs are part of it. Trade makes up about 15% of the United States economy. It makes up much more of, for example, Canada, Mexico, Europe. So they have more to lose. And going into this, our economy is doing much better than those economies. The jobs number came out this morning. It was plus 228. That was above expectations. The unemployment rate's at 4.2%. That's very, very low historically. Jobless claims, that's the leading indicator of jobs. And that's what the Fed will focus on is the jobs numbers. That remained, it was out again yesterday, remains very low, around 212,000, I believe it was. Anything below 250 is really low, not indicating a recession. We've watched credit spreads. They've widened a bit. That's an example of how concerned the credit markets are about a recession, but they haven't exploded like we would see in a recession. So there is a risk that I'm not going to sugarcoat it. If the trade war gets worse, there could be a recession. But pointing out that, for example, the oil prices, well, because of a combination of concerns that economic growth will slow and OPEC increasing production yesterday, oil prices have dropped 12% over the last 2 days. That'll translate into lower gas prices. Well, that helps the consumer to save more money. That may offset some of the rise that we'll see. And we don't know how much of a rise we'll see due to these tariffs. Companies have been very profitable. Will they choose to eat some of the tariff costs and not pass those on to the consumers? For example, Ford last night, they're already offering employee pricing. So I think other companies will try to do that to take advantage of this situation and the fear that consumers have that they are going to be paying higher prices. And I don't want to go on too long, but I just want to say one more thing. The real concern is what's called stagflation, that we have the inflation that caused by tariffs combined with slowing economy that will tie the Fed's hands and they won't be able to respond. I think that's an unrealistic worry. The Fed, through Powell talking about it at his last meeting, now he's never going to come out right out and say it, but he signals things and you have to kind of learn how to know his signals. But he basically said that the Fed is very concerned about the employment rate and they will act if the unemployment rate starts to go up. Combined with, he made sure to point out, and he didn't use the best choice of words in my opinion, but he said that the inflation caused by the tariffs is quote unquote transitory. We've heard that before, but that just means they'll be temporary in their minds, which he said that to mean that that won't deter them from coming in and stimulating the economy if they have to. So I think that's what investors need to remember, that over the past 20 years, we've seen the Fed has come in and they've done things that nobody thought were possible. They flooded the market with cash. They bought treasuries. They bought mortgage-backed securities. They took the interest rates to zero. I don't think we'll need any of those things, but they are committed to keeping the United States economy rolling. And that's I think should be a comforting thing, that if the economy does go into a recession, the Fed will act, and any temporary inflation that we see from tariffs isn't likely to deter them to a great extent.
Well, the one thing that I like that you just said is, and I'm thinking back in the beginning of the really bad inflation that we had back in 2022, was the immediate rise in gasoline prices was not only reflected by everybody going to the pump, but it also dramatically increased transportation costs because the trucks and the rail shipping products to the stores helped jack up inflation. So if in fact we do see a drop in oil prices, and we talked about it, that you said that OPEC just recently agreed to ramp up production to drive oil prices down, they represent a very good part of the inflationary numbers that could offset some of these concerns with tariffs. Is that correct?
Yeah, that's correct. A lot of the energy goes into, like you mentioned, so many things. You wouldn't think that your your Amazon delivery. Well, it's the cost that we get the products from China. It's the delivery driver. Well, it's also the gas that the Amazon truck uses, the airplane that gets it there, the fuel that runs the factory. All of those things goes into it, and energy is a big part of that. And it's a sentiment thing too. We've talked about this, you and I. There is no better inflation gauge to the average person than gas prices, because you see the signs. There's nothing else where you see the signs of prices everywhere you go. That's a real-time measure of gasoline inflation. So seeing, for example, in where I live, I saw the first $2 and something gas in a long time last week. And like I said, my daughter just got her permit, so she noticed that because she's worried about gas prices. My wife noticed. She doesn't really pay attention to that stuff. So that just shows that when you get that, it can be a psychological boost as well to consumers that, hey, gas prices are going down, prices are going down. That will help. This has been a big concern. Apparently, egg prices are down about 30%, and that also is something. So, and that's the other thing. That's what I want. Everybody's focusing on the tariffs, and they are important. But there's a whole other side of the economy as well. The administration, there's tax cuts being talked about. There's a deregulatory environment that really reduced costs. Companies were really under the gun under the Biden administration with increasing costs to meet regulatory burdens. And that's another cost that can be stripped out. So the timing might be a little bumpy. So we could get a negative quarter of growth, but we could also get some stimulus coming in at the back end of that that gives us a shot in the arm and keeps us from having a prolonged recession. So just don't pay attention to the one thing and say that, well, there's nothing that will offset that. There are always things that will offset that. Companies will learn how to deal with it. The Fed will offset things. Government will come in and help if they need to in certain areas. So that's the yin and the yang of the economy.
Well, there's a lot to be said there. And now, going back to one of my first comments right out of the gates in this episode was the underlying value of the stock market is based on the individual stocks, based on their earnings. And I think there's going to be, we're getting ready for first quarter earnings season. It's going to be kicking off in a couple weeks. And through the month of April, we're going to see a giant amount of earnings reports. But the investors aren't going to be looking as much at the earnings as they are going to be looking at the forward guidance that the corporations are going to be providing, which again sounds like they're going to be throwing out numbers lower on purpose simply because of their uncertainty. And companies don't like to give high guidance and not meet it. They'd rather give low guidance and exceed expectations. Care to talk about the earnings, please?
Exactly right. And that sets us up for another second half potential rally, is that this is probably going to be what's a kitchen sink quarter, is what we call that. That companies will be cautious because of the tariffs. They will lower guidance, most likely, a lot of them, because they legitimately don't know what's going on with tariffs, and they are concerned that costs will increase. But they will also blame a lot of other things on tariffs that are really just operational issues that they should be fixing anyway. So that's why you call it a kitchen sink. There's a big issue that they can blame everything on. But that sets up for low expectations. That's what we like going forward, because it's easier to beat those. Companies aren't just going to. That's one of the great things about America. American companies don't just sit there and take these things. They react to them. They learn how to deal with them. They'll complain about them, and they'll learn how to deal with them and find new suppliers. Like I said, it might be bumpy at times. There will be some winners and losers, but that's why we have diversified portfolios and make sure that investors are spread out among these companies, because some won't do as well as others. But thinking that everything is just static and okay, the president is going to implement these tariffs and let's just see what happens. Well, no, there's a whole bunch of other stuff that's going on, and companies are meeting right now and how they're going to deal with them, how much of that we're going to pass on to consumers, where we can get supplies. A lot of companies, in fact, have already loaded up their inventories and bought ahead of the anticipated tariffs. So if we get some negotiations, they may never even have to pay those tariffs because they don't have to order again for a few months because they already have supplies on hand. So all of those things will go into this. So saying the world is ending, which it seems like the market has been saying the last couple of days, is a bit of an exaggeration.
Well, it's interesting you say that too, Brad. I would think that if companies were loading up and building up inventories in Q1, then that would decrease their earnings for Q1, which could then lend itself to lower earnings for Q1 for that reason. Is that true?
In some cases, that will be true, and investors will see why that's true, so they won't be punished for it. But it does set up for a chance to, again, surprise on the upside as they go forward, and that's what we want. So, this is like we've talked about, they never feel good, but there's a 10% correction or more almost every year in the stock market. The last 2 years have been the rare exceptions where we've seen these. And by the end of the year, 75% of those times, the market's up. So it never feels good. The world is ending all the time, but we managed to get through it. We're at much lower valuations now. We're in a much better starting place. So it never feels good when it's going on, but like the eminent Warren Buffett says, you buy when there's fear in the market, you sell when there's greed in the market. In the last 3 months, we've seen there was greed and exuberance in January, and there's fear now. And if you had followed his advice in January, you'd be sitting pretty. And I think if you follow his advice now, there's a lot of fear. You'll probably be sitting pretty in a year as well.
Right, and buy-in at this time. So lastly, I did like your comment about the diversification because to your point in 23 and 24, everybody loves stocks and they hate bonds because bonds are just tooling along and barely making anything. And suddenly we get a giant rally in the bond market because everybody's selling stocks and buying bonds. And also, the 10-year Treasury just dropped precipitously in the last couple of days. Again, people are selling stocks and buying bonds. It's dropped below 4%, which actually is good for the economy, isn't it?
Yeah, lower interest rates, and that's something that President Trump's been railing about. The housing market's been railing about. That is probably more than anything stimulative to the economy because people can borrow money at lower rates. People can get mortgages at lower rates. People can refinance mortgages at lower rates. So it adds cash to the economy. Difference between a 7% mortgage and a 5% mortgage, depending on how much you have, is quite a bit of extra money in your pocket. So that all helps. And yeah, and that you just pointed out a great point. The people that were frustrated in 24 that they weren't all allocated to large cap growth, well, they're thinking they're lucky stars that they have some bonds now because that's what's holding up their portfolio and why their portfolio isn't down 17% like the NASDAQ. It's only down 8 to 9% because their bonds have cushioned. So that's why you're diversified. This is exactly why that is.
So we're wrapping up the episode. It sounds to me, Brad, what I'm getting the sense from you is that the sky isn't falling and everything isn't cratering and it's relieving to know that fundamentally the United States economy is still on firm footing. It's just that there's a lot of fear, some warranted, maybe not, or overextended, whatever.
Yeah, and that's where we are. And I don't know where the bottom is. I don't know but I'm confident we've seen this before. The market goes down and then it goes back up because the American economy is resilient. American companies are free to innovate and make decisions, and they have a big incentive to earn money, and the consumer is still in good shape. So that all leads to the belief there's nothing structurally wrong. Like back in the financial crisis, we had a major problem with some of the banks being overextended. Well, no, all the banks are in good shape. So there is the tariffs do cause uncertainty, and that's not great. And I'm not saying it's happy, but you invest in the stock market for the long term. And I think you'll look back in a year or two and go, boy, I'm glad I held on there because we got a nice rally going on.
Yeah. Well, thank you very much again, Brad. I appreciate the time and look forward to, well, seeing you every week, but having you on next quarter again, unless something weird happens along the way that we want to jump in and have another episode. So thank you again, Brad. You have a wonderful day. Thank you to all the viewers and listeners. Hope you got something out of it today, and hopefully at a minimum, just kind of dispelled some of the fears that you may have. So thank you for joining us, and hope you have a wonderful day. And thank you again, Brad. I appreciate it.
Thank you. Glad to be here.